Hello, my name is Adrian. If you're watching this video, it's probably because you're curious about investing and how to get started and sort of what investing even is. I'm not a professional investor by any means. I don't work for a bank or an investment firm, but to be honest, nowadays you don't really need to work for one of these places to be a great investor. You just need to be knowledgeable, you need to do your research, you need to understand what you're doing. But the best investors, they invest themselves. They don't go through companies and institutions. They take care of their money on their own, and they eliminate the middleman. You save on fees. We're going to touch a little bit about all of that. But basically, I just want to give you a little breakdown on how I view investing, what investing means to me, how I got started, and give you a couple ideas of ways that you can sort of get started with investing. This is a really good place to start. There's some fundamentals that I'm going to give you. There's a breakdown sort of some of the simpler methods of investing. And then from there, you can kind of do your own research and get any more information that you're looking for. So a great place to start. The conversation I always like to explain to people is, what is investing? So here we have the Earth. It's a beautiful Earth, and you can see that there's a tree on the Earth. Now, that one tree is going to enter the economy. Right now, we're going to value the global economy at $1,000. Let's just say, obviously a fake number. The global economy is worth $1,000. Now, we got two guys here. One of them is a businessman, and he goes and he cuts down that tree. And now he sells that tree to his friend for $20. They exchange that $20 for that tree. And now the first guy's happy, he just made $20. The second guy's happy, he can go, light a fire and heat his house and provide his family with warmth. Great. Now, where did that $20 come from? In theory, there was $1,000 floating around the world, right? And the second guy here, he took a $20 bill and he gave it to the first guy. But now he has that tree. So in theory, that tree was just inserted into the global economy from nowhere. It was growing in the ground. It didn't have a dollar value assigned to it when it was growing in the ground. But that guy just took it and inserted it into the global economy. So now our global economy is worth $1,020. And so this is the key component of understanding how economics works and the growth of the market in general. As we exploit the Earth for its resources, we are creating money. We're cutting down trees and we're selling them where those trees didn't have value before. We're mining rocks out of the ground. We're pulling oil out from underneath the oceans. All of these different things contribute to growth of the economy in ways that is sort of artificial. The only way that this can possibly stop or slow down the growth of the economy is if either we run out of resources or a catastrophic event comes down and blows up the planet, and now there aren't any people to trade the market anyway, so it doesn't really matter. But generally speaking, the concept is simple, that over time, the more and more and more that we exploit the world's resources, the global market, the global economy is simply going to increase. What we found is that the rate of increase is approximately 10%. So if you look at global market data over the course of the past 100 years, it sort of averages out to be an annual return of approximately 10%. Now, obviously, it's not that pretty. There are some ups, there are some downs, there are some ups, there are some big downs, but generally speaking, it averages out to being approximately 10% annually. Now, the thing about an annual 10%, that doesn't just mean that you're going to gain $10 every year on a $100 investment. That doesn't work like that. 10% means that as you start to grow and you add on and you add on and you add on, 10% each year becomes an exponential graph like so. I'm going to break this down for you. So the first year we have, say, a $100 investment and we add 10%. We're obviously adding $10 and our new value of our investment is $110. Great. The next year, we add another 10%, but we're starting with 110 now. So that 10% becomes $11, and now we have $121. The third year, we start with those $121, and we add 10%. Well, now we're adding $12.1 on that. It's the same 10% growth. We're just getting a little bit more and a little bit more each year. All right, and it continues on like so, approximately 133, approximately 146, 161, 172, I think, if I have it right. Year 8, we have $195. We're adding 10%. That's $19.5. Look at that. That's basically double of what we were adding at the beginning. Same thing down here, 215, we're adding 21.5. We started by adding $10. Now we're still only adding 10%, but we've just accumulated enough that we're starting to see that exponential increase of going up by more and more each year. Here we went up by $1, here we went up by $1.10. Well, down here we're going up by $2. We're going up by $2. Still 10%. And so when we look at the greater picture here, if we add the first 3 years together, we get a value of $33.1 earned. If we look at the last 3 years, 19.5, 21.5, and 23.5, we get a total of $64.50 earned. We've still earned 10% per year, but we are further along on that exponential graph, on that compounding graph. So those first 3 years, we earned our $33. Those last 3 years, well, we're way up here on the chart. So we're earning in the same time frame almost double the money because the 10% compounded. All right, that's a very critical concept to understand, is a concept of compounding. And I'm going to break it down with some actual numbers down here. I went ahead and did some math beforehand. We're going to do a compounding calculation. Now this is, I'll write it down for you so you can actually remember it. This is absolutely critical, and this was really the first thing that got me interested in investing back when I was a teenager. If you look up a compounding calculator and you put in some numbers that are realistic for you, you're going to be amazed at what you can earn in 10, 20, 30, 40 years, okay? So I'm going to give you two concepts, or two different scenarios, we'll say. So we have Jennifer and Mark. Now, Jennifer and Mark were both born in the same year, so they're the same age. Only difference is Jennifer started investing when she was 25. Mark waited till he was 40 because he thought, well, you know what? I don't want to invest early. I don't have that much money, so I'll wait till I save up a larger amount and I'll invest it then. So Jennifer invested an initial investment of $2,000, fairly reasonable, and she did some budgeting and realized that she could afford to save $150 per month, every month directly deposited into her investment account. She started this when she was 25. She watched my video, she realized the power of compounding, and she started this way earlier in life than a lot of people will. Mark, on the other hand, waited till he was 40, and he saved up a pretty significant amount. He had 10 grand that he could drop into the market, no problem. But he only deposited $100 a month because he wasn't really sure about his budget. He hadn't really thought about money much in his life, so this was about all he could spare. All right, still a decent amount of money, but when you think about it, if you look at this 10,000 and the 2,000, that's a pretty significant difference versus this 150 and 100 looks a little bit of a smaller difference, but I'm going to show you this effect. So this is Mark's value graph down here. You can see that he starts at the age of 40 and starts to increase, and he comes up with $231,000 by the age of 65. That is assuming a 10% annual increase, compounded, I should say that. So what we're doing here is we're banking on a 10% gain every single year. Obviously some years are less and some years are more in real life, but for this calculation, 10% gain every year compounded annually, we result with a saving of $231,000, give or take a few bucks. Now, Jennifer started with the smaller investment. She did invest a little bit more per month, and you're going to see the significance of that combined with the time. When Jennifer is 65, she is going to have $923,000 in her investment account, give or take a few bucks again. Okay? So there's two reasons why this number is so astronomical compared to Mark's. The first is that she started earlier. She started when she was 25 instead of 40. And even though she could only put a little bit in, she figured out how to save every month, and those early monthly contributions are going to ride that compounding curve all the way, so that by the time she reaches 40, those $150 a month deposits are starting to really rack up some value. Not only that, she has an extra 15 years on Mark. Okay? So where Mark's graph looks like the one below that I just showed you, her graph looks a little different. She started way down here. He started with 10,000. She only started with 2,000. So by the time she's 40, there's a good chance that she might even still have less than Mark. But with time, she gets onto that compounding exponential curve, and that is the difference. All of this time that she has stayed in the market since she was 25 is now coming to fruition to result in this ridiculous slope at the end of her investing career. So, well, I mean, assuming that she takes it all out at retirement, but she's riding that exponential curve longer. And so this inflection, this steepness is what we're looking for. Generally speaking, what we want to try to do to be able to retire comfortably is get it to the point where every year this value of increase of our investments results in, let's just say, approximately $50,000. All right? Think about it this way. If you're averaging a 10% return every year, $50,000 is 10% of a $500,000 portfolio. So essentially, when you want to retire at the age of 65, if you do not want to have to earn another dollar for the rest of your life, now again, this is very basic, very generalized. If you have a $500,000 portfolio invested in the stock market, it's going to produce $50,000 on average every year. That's enough to pay for, if you still have a mortgage, grocery bills, travel expenses, whatever. That's a pretty good median salary right there. A lot of people don't even make $50,000 a year. Now, there are some caveats there. You don't want to have your $500,000 purely invested in the stock market when you're 65, because if the stock market crashes, there goes all your money. Good luck buying things. But that's sort of the idea. What we want to be able to do is have our investment portfolio generate enough passive income that we can basically live off of it for the rest of our life. And then essentially, if you take that out, well, what's going to happen is you get up to that point, and now because you're withdrawing that money every year, it's kind of just going to do this. It goes up a little bit, and then you take it out, and then it goes up a little bit, and you take it out, and it goes up a little bit, and you take it out. But because you've got it up there, because you invested so early and so often, you can just kind of ride that indefinitely, in theory. Okay? So again, search up a compounding calculator. There's a million of them on Google. Put in some numbers that are realistic for you and see what it comes out based on your specific goals or if you have an investment account already, what it can do. So the other thing to note is the proportion of these accounts. So Mark's account is worth $231,000, right? So he has deposited a total of $40,000 in the, 25 years that he was investing. He's deposited a total of $40,000. Okay. Now Jennifer, she was investing for longer. She actually invested $74,000 of her own money into the account. Now, that seems like a lot of money to just put in a savings account, but again, it's per month, a small amount. It's going to add up. But you'll notice that Jennifer, even though she's saved more money, it's a much smaller percentage of her portfolio. That is, again, the power of compounding. So Mark invested $40,000, and his investments over those 20 years generated $191,000 of interest. Jennifer invested $74,000, and her $74,000 over her 40 years investing generated $849,000 of interest, or of returns on the market, or in whatever she was invested in. Okay? Now, you'll notice that the first two numbers, 40 and 74, they're not that off. She only invested an extra $34,000 more than Mark in the extra time that she was investing. But that extra $34,000 resulted in an extra earnings of $658,000. She literally earned more, almost 3 times more than Mark's entire portfolio, simply because she started early and she started often. She invested from a young age, and she invested a small amount every single month consistently. It's insane how much you can generate just by investing early and small amounts frequently. Again, do the compounding calculator. You're going to be absolutely blown away, okay? So this is the concept of what investing is, and this is sort of the main concept of how to invest, but what do we invest in? You've probably heard of stocks and the stock market and everything. If you're completely new, even those might be new words, but for the most part, everyone's heard of the stock market. What is a stock? What are we investing in? Here's a list of some companies And I'll talk about the numbers in a second. I'm going to try to avoid numbers for the most part, but starting now, we're going to have to kind of discuss numbers for a little bit just to kind of get some of these concepts across. So here's some companies that you're probably familiar with: Apple, Microsoft, Home Depot, Visa, Disney, Pfizer. Obviously, in the past couple of years, you're probably going to be familiar with. These are all companies that are publicly traded. Now, what that means is they've released shares into the stock market that people can buy. So I can go onto my brokerage account, and I can buy one share of Apple. Now, Apple's a massive company. They're worth trillions of dollars. I can still go buy that share, and I can become a 0.00000000001% owner of that company. Now, if you were able to take $100 trillion and invest in a bunch of different companies in the market, you could in theory own every company in the market by getting a 50% stake. Obviously, that's not possible. But let's just take Apple. Let's just say I had $1 trillion. That's about, Apple's worth, actually, I think they're about $3 trillion now. So let's just say I had $1.5 trillion, and I went, I don't know why that happened, and I went and I bought $1.5 trillion worth of Apple stock. I would now own 50% of the company. Well, I can make the decisions. I can call the shots. As long as I own 51% actually, or 50.1, I can basically decide what I want to do with that company at any given time. But again, no one really has $1 trillion or $1.5 trillion to invest in this company. But you can get pretty big stakes once you look at Warren Buffett, for example, owns 5% or 10% of several different companies because he's sort of accumulated this wealth and accumulated these shares. Regardless, that's not really important. What's important is that you can own a tiny, tiny, tiny fraction of a company, and you can benefit from the value of this company going up. Now, here's a 6-month return on all of these stocks. This is these are real numbers as of when I made this video. So in the past 6 months, Apple's stock has increased by 16%. If you invested $1,000 in Apple stock, you could get, however many shares that is, and all of a sudden your shares are now worth $1,160. Great. The company's value increased. Your investment, your shares, thus increased in value. Now, to be honest, this does not have to do with sales of a company. It all has to do with people's outlook and people's thoughts about the company. If people think Apple products are great and they think Apple is going to be a very successful company in the next little while, they will buy those shares. And when more people want to buy those shares, that means you can sell yours for more. That means the value is going to go up. Even if Apple didn't even change its actual sales numbers or its financial outlook at all, because people think it's more valuable, the share price goes up. And the same thing with going down. Look at Amazon, down 12% in the past 6 months. If you invested $1,000, it would now only be worth $880. Why? Who knows? There are obviously going to be reasons. I didn't research into Amazon why it went down 12% before talking about this, but for the most part, people thought Amazon was overvalued, or they thought that its value was less than what it currently was. So people started to sell their shares, but they kind of wanted to get rid of them. So they sold them for a little bit cheaper than it was worth. And the more that happens, then the value of the stock goes down. So it doesn't, again, really have to do with sales and actual performance. It just has to do with sentiment. It has to do with what people think these companies are valued. So how do we know which ones to invest in? How do we make sure that we invest in Apple and not Amazon? How do we make sure we invest in Home Depot and not Disney? How do we make sure that we're getting more money and not losing money? Well, when you invest in one stock, you're giving yourself entirely up to the mercy of the market and the other people that are buying and selling these stocks. You really are completely exposed. If that stock tanks, so does your investment. If that stock skyrockets, though, you can see these big gains. So there's something that we can get that sort of reduces this risk. And it's called an ETF. Essentially what an ETF does is it invests, let's just say your $1,000 in, how many stocks do I have here? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, I should have drawn out 10 stocks. I'm just going to go ahead and erase Pepsi down here. So let's just say you take your $1,000 and you buy an ETF that invests in all of these stocks. What you're doing is you're putting $100 into each of these companies. So let's just say this is called the top 10 ETF, just for the sake of argument. These aren't the top 10 stocks, but let's just say they are. Then if you get $1,000 worth of this top 10 ETF, it will divide it up between these companies. And so then if one company goes way up or one company goes way down, you don't really have that effect in your portfolio. You don't really see that. Generally speaking, as long as all of the companies start to go up on average, then your value, your investment will increase. Okay? So here's some sample ETFs. VTI, these are all through Vanguard. I just picked a company and went with it. VTI is the total market. That is basically investing in the entire market all at the same time. In the past 6 months, it's gone up by 4.5%. So your $1,000 becomes $1,045. VXUS, that's international. So ex-US, without US, it's everything but the American market. It's gone down 2.4%, so your $1,000 would now be worth $976. But then look at the rest of these. So VOO is the S&P 500. That's like the largest market in the States, up 6.5%. The energy sector of the American market, up 26%. Energy stocks have been absolutely booming. You could go get, 6 months ago, you could have got shares in one energy company, and it's kind of hit or miss still if it goes up or down. But if you've gotten this VDE ETF and given yourself exposure to a larger proportion of the energy sector, if you think that energy stocks are going to go up, why invest in just one and roll a dice? Invest in all of them by getting this VDE ETF. And now you think that whole sector, it's called, you think that whole sector is going to increase in value because the price of oil is going up. You're not gambling on if you're picking a winning stock or a losing stock. You're gambling on, is that whole sector going to be going to increase in value or not. And for the most part, it's a little bit easier to predict that than it is to predict the value and the growth of single stocks. A couple more examples here, VOOG and VOOV. So these are all, you can see they're kind of derived from VOO. VOOG being growth stocks, VOOV being value stocks. So growth stocks are stocks that are expected to do really well in the next little while. They're maybe they have new products coming out. Maybe they're back in the day, maybe they were vaccine stocks. Back when coronavirus just hit, for example, obviously those are going to grow pretty significantly. Value stocks, on the other hand, are stocks that are currently undervalued. So their stock price has fallen pretty significantly, but they're still really solid companies with great financials. There's not really a reason for their stock price to go down. Well, those are what we're going to call value stocks. So you can see that the numbers are a little bit smaller besides the energy sector, 6.5%, 4%, 2%, 5%. But for the most part, it's sort of beneficial, especially early on in investing, to limit your risk of having one stock absolutely blow up on you by getting ETFs instead of single stocks, because now you're sort of distributing your exposure, you're diversifying your portfolio. And so, you won't necessarily see those plus 30% returns very often, but at the same time, you're also not going to see those minus 30% returns. So ETFs, definitely something to look into. Go check that out. It stands for Exchange Traded Funds. Do a little bit of research on your own. Go check out some good ETFs. Decide which ones you want to invest in. So speaking of ETFs, I'm going to show you a sample portfolio. This is this is how I invested when I was 18, 19, or really early on in my career. At that point, I was with TD Bank. This portfolio, by the way, is from Canadian Couch Potato. Really good provider of sample portfolios just for people who don't want to do all this active investing. They don't want to manage their portfolio. They just want to invest their money in something solid and let it sit. Canadian Couch Potato is great for just suggesting, here's some ways that you can invest your money that's pretty safe. It'll grow. It's not necessarily going to go up 50% overnight, but long term, we're looking at retirement, right? For the most part, investors should be looking at retirement 40 years down the road, 20 years down the road, long-term outlooks. So here are the three things that I invested in when I was 18. TDB 900 is the Canadian market. TDB 902 is the American market. And TDB 911 is the international market. Now, these are specific to TD Bank. These are specific to TD Direct Investing Platform. But there's a concept here. You see Canadian, US, and international. Basically, what that's doing is going up to our very beginning here, and I'm investing in the Canadian market, I'm investing in the American market, and I'm investing in the international market. What am I doing there? I am basically investing in the entire world all at the same time, trying to ride that global economic growth of approximately 10%. That was the goal, annually compounded, right? And so, where are we here? I just divided it up. And I said, okay, well, the U.S. market is huge. The U.S. market is the biggest market in the world. I'm going to put most of my money there. So I put 50% of my, let's just say 10,000. I just put a number down for easy rounding. Let's just say I put 50% of my 10,000 in the U.S. market. I bought $5,000 worth of TDB 902. I did the same thing with the Canadian market and the international market. I put a little extra in Canadian because, I'm Canadian, so obviously I want to invest a little bit more at home. And then I put 2,000 in TDB 911. Generally speaking, A year later, let's just say this is what happened here. 16% return on the entire portfolio. Great, cool. Not a bad number. Generally going to be something around that ballpark. Maybe 16, maybe 7, who knows. My $10,000 1 year later is now worth $11,600. Great. What do I do now? Do I just leave it where it is? Well, no, I would rebalance it a little bit. So I still only had these 3 things. I wasn't getting more. I wasn't getting individual stocks. I wasn't, going to sell one off completely. I said to myself, well, TDB 900, the Canadian market, went up 16%. It's now 3,500. Cool. That's approximately what my whole portfolio went up by. So it's sort of expected. It's in line with my expected returns. So I'm just going to leave that the same. So to rebalance that, I'm not going to do a damn thing. TDB 902, the American market, blew up in a year, up 40%. Now, if you've ever seen a stock chart, to see 40% in 1 year, that's a little ridiculous. So is it going to be able to maintain that growth? Who knows? Probably not. And I would always go off probabilities. So what I would do is say, well, if the American market went up by 40%, look at the international market, it went down by 45%. What's the number one mantra with investing, with buying stocks, with buying anything really? Buy low, sell high. You've probably heard this before. You buy something when it is undervalued, and you sell it when it's overvalued. You go to a used video game store and you buy a used video game for $15. You go to your buddy down the street who really likes that game. You go sell it for $30. Boom, you just made $15. You bought it when it was undervalued because it's used. You sold it when it was overvalued because this guy just really likes that game, right? You can do the same thing with cars. You can do the same thing with anything in the world. You can buy it when it's low and sell it when it's high and make money. The only issue is there's not many places outside of the stock market where people are going to want to buy things when they're overvalued, right? So with that being said, what would I do? I would sell my overvalued piece, my US market, and I would buy some of the undervalued piece, the international market. So basically I would sell off some of this really well-performing one and buy some of this underperforming one. And generally speaking, because this one went down in that year, well, law of averages, it's pretty likely to go up. Generally speaking, this one went way up that year. Well, even if it doesn't necessarily come down a lot, it's probably not going to be able to hold up that 40% return the following year and the year after that and the year after that. So what I want to do is sell it here so I don't get that downtrend and buy it here so I do get that uptrend. It's just law of averages, guys. And back in the day when I was starting out, this was the simplest way to consider things. But over time, I've started to sort of learn a bit more. And so here I'm going to break down another sample portfolio, a little bit more complex, but still pretty basic. So I've still got a bunch of ETFs, but I started to expand into some dividend stocks and even getting some bond exposure. So this top half here, this stocks and equities, those are a little bit of a higher risk investment. Down here though, this bonds, fixed income, and cash, those are a bit more secure of an investment. So as you get older, you do want your money to be in a secure place. Like, there is nothing more secure than a savings account, but you're only going to get like less than 1% return on your savings account. So it's really not a great option to keep your money. But you also know that even if the stock market goes way down, your $1,000 is still going to be worth $1,000. Now there's inflation, so it won't really be valued at $1,000. You'll still only be able to buy, $950 worth of stuff, but it's not going anywhere. So over time, you do want to sort of shift into a bit more of a secure portfolio. At my point right now, I'm able to take on a bit more risk. So this is even a bit more conservative than my actual portfolio, but just for the sake of explanations here, 75% in my risky side, 25% in my low risk side. And there's a rule of thumb out there that your low risk sides should sort of equal your age. So by the time you're 40, you got 40% in the low risk. By the time you're 60, you got 60% in the low risk. So the closer you get to retirement and not earning money at work, the more secure your investments are. Let's put that aside for now. This sample portfolio, let's put in $50,000. So I've got a few different ETFs at the top here. These are through iShares. This first one, IVV, that is an ETF that tracks the entire S&P 500, which a lot of people consider the market. That's just one of the market exchanges in the States. And so that's a great building block to start your investing portfolio, is just invest in, generally speaking, the overall market. So I put 30% in IVV. I bought $15,000 worth of this ETF, this IVV ETF. And then I went down and I got some mid-cap stocks. So mid-caps are a little bit smaller value than large cap. There's small capitalization, mid-capitalization, and large capitalization. This is the level of capitalization of the market. We're getting really complex. We're not going to go into that. But basically, there's small companies, big companies, and medium-sized companies. So what I want to do is invest specifically in some medium-sized companies. Because for me, I really like medium-sized. I like mid-caps. They still have a lot of room to grow, but at the same time, they're not going to be as volatile as the small companies. It's not like they're just going to all of a sudden go bankrupt one day. There's some companies out there that are completely speculative. They haven't sold a thing. They're just kind of they exist because they have plans. If those plans don't come to fruition, that company is going bankrupt. If you invested in that single company, that single stock, you're probably going to zero. So good luck. Have fun with that. Mid caps just kind of give me a bit more exposure to that upside where they could sort of increase in value pretty significantly because they're not like fully formed, I'll use that word, fully formed companies yet. But at the same time, they're a little bit lower risk than the small companies. So that being said, because there is a little bit more risk than the very, very, very large companies that are contained in the S&P 500 market index, I'm putting a little bit less money there. I'm putting 15%. That works out to $7,500. Cars.to, one of my favorite ETFs. This ETF is full of stocks to do with electric vehicles and the production of electric vehicles. Now, in 5 years, there's really not going to be much gas vehicle production at all. Like, it's going to be all electric, and that's literally within even 5 years. And so when we're looking 20, 30 years down the road, there's no telling what these companies are going to be able to do. So I want to put 10% of my portfolio in Cars.to. I want to put 10% in a bunch of different stocks, all contained within that ETF, that give me exposure to the electric vehicle sector. If electric vehicles, all of a sudden someone says, oh, you know what, these are awful and they're never going to work, and the whole world agrees, then yeah, maybe this $5,000 gets completely devalued down to zero. But the chances of that are very, very, very unlikely due to the fact that every single country is putting a ton of stock into production of electric vehicles and reducing carbon emissions. So for me, that is a super safe investment. Now, at any given time, this could go down to $4,000, $3,000 worth of value, depending on sort of how people value this ETF. But again, I'm looking 40 years down the road. So the chances of this $5,000 being more than that in 40 years are pretty friggin' good. Now, you'll also notice I have some dividend stocks here. So I have started investing in individual stocks over the past few years. I'll give a shout out to Shopify for helping Taylor and I buy our house. But dividend stocks are different than regular stocks because they're going to pay you a little bit extra money for holding them. We're going to talk about that in a minute. But basically, maybe I'll put 4% of my portfolio into 5 different stocks for a total of 20%. So, I buy $2,000 worth of one stock, $2,000 of another stock, $2,000 of another stock, and I have 5 dividend stocks in my portfolio. Again, we'll talk about dividends in a second. The lower half here, you don't have to worry so much about. So these right here, bonds, you can think about that as loaning the government money. Now, they're not going to give you that much money. They're going to generate a very small return. But, it's a very secure way to keep your money, and it will grow. The bonds are designed that they will grow over time, just at a lower rate than stocks or than the market. They're not even going to reach that 10% at all. But over time, you shift a little bit of your investments from stocks into bonds. You can still get growth, but at the end of your retirement journey, when you actually do retire, you've sort of hopefully grown your investment portfolio to the point where it is sustainable. So you don't really need that big growth. You don't need to take on that risk. I also like to hold a little bit of cash on one hand so that it's there if I ever do want to make an investment, if an opportunity comes up. Like, let's just say Microsoft stock cuts in half in like a week. I'll take some of that 15% cash that I have free and I'll go buy some of that Microsoft stock. Because if it goes down by 50% in a week, unless, again, like maybe the whole company got blown up, unless something like that happened, it's law of averages. It's probably going to come back up at least a little bit, even a portion of that 50%. That's going to be a pretty good investment. As the market starts to reach really high points, maybe the market's doing really well, I'm going to sell off some of my equities, my stock allocations at the top here, and I'm going to increase the amount of cash I put or that I hold. Because when the market goes up, I want to sell high, hold more cash, maybe bring this up to 25%, and when the market comes down even a little bit, well, now I have more cash to buy that low point. Right? So you do not always need to have all of your money invested. That's another point. Okay, moving on. Rebalancing. I mentioned rebalancing up at the top part. What is rebalancing even? Well, let's just say I have $10,000 in my portfolio. divided up into 3 stocks. And I want one of them to hold $5,000 worth of my value. I want the other ones to be worth $2,500 of my value. Okay? So we have weightings of 50%, 25%, and 25% of my portfolio. At the beginning of the year, stock A is worth 50%, stock B is worth 25%, stock C is worth 25%. As time goes on, at the end of the year, maybe stock A has gone up to 70% of my portfolio. It's become $10,500. That stock nearly doubled in value. Great, awesome. I love to see that. The only problem is now it's a huge proportion of my portfolio, and maybe I don't want 70% of my portfolio to be in stock A. Conversely, so by the way, this is at the end of the year, my 10,000 is now worth 15,000, and here are the proportions. So stock B was worth 2,500. It was 25% of my portfolio. Now it's worth $3,000. So it also went up, but it's now only 20% of my portfolio because stock A blew up so much that it's taken up all of my portfolio value. And then stock C was worth 2,500, is now worth 1,500. It lost $1,000. It's now only worth 10% of my portfolio, right? 1,500 is 10% of 15,000. Okay? That's where these numbers are coming from. So what do? Again, I sell high and I buy low. I want to rebalance to my initial weightings. There was a reason that I picked 50 and 25 and 25. Whatever those reasons were, there was a reason. So now how do I get it back to 50, 25, 25? Well, I know that the target, my target value, so now I have $15,000. I went up $5,000. That's still there. But I know that my targets now, my 50% target is $7,500 of that 15,000, right? And then my two 25% targets are now $3,750. So what do? I want to bring this back to a 50% proportion of my portfolio, right? Remember over here, I decided that I wanted that to be worth 50%. So it's worth $10,500 and I want it to be worth $7,500. So I sell $3,000 worth. Cool. Now what do I do with that $3,000? Well, down here, my 20% originally that was my 25% stock B, right? It was worth $2,500 and it's now worth, sorry, I should put this here. It's now worth $3,000. Okay? So it did go up, but it went down in percentage of my portfolio. So we need to bring that up to $2,500. So even though the value of that went up, it did get higher. I still want to buy more. What do I want to buy? Well, it's worth $3,000 now. I think I messed up the numbers earlier, but this is going to make more sense. It's worth $3,000 and I want it to get to 25% of my portfolio, which is $3,750. So what do I need to do? I need to buy $750 using the $3,000 that I took off of that top one. Same thing down here. This one is now worth $1,500. It went down, right? I want to bring it back up to 25% of my portfolio, which is $3,750. So I need to buy $2,250 worth of that. You add these up, those equal $3,000. So I've sold off $3,000 of stock A and I've bought $3,000 worth of stocks B and stock C. And now all of a sudden the values are 50, 25, and 25% of my portfolio. Even though it's still $15,000, it's $5,000 more than it was before, my percentages are back to where I wanted them to be. Okay? That's rebalancing your portfolio. Really quickly going to touch on dividends. What is a dividend? A dividend is when a company pays you for holding their shares. This is basically a bonus on top of the share value that we're hoping increases. So if a stock costs $10 per share and they pay a 10% dividend, they're going to give you $1 every year, literally just for holding that stock. So if you hold 100 shares, that's $100 for free every year, right? Now there are more specifics, more things than that. I'm going to say Google dividends. You need to learn what dividends are. It's free money. How is it free money? Well, the stock price hopefully increases at approximately 10% every year, right? Well, what about those dividends? They're giving you free money. It's a tiny bit of money here, and it's a tiny bit of money here. But if it's a very well-performing company and they have good financials, they might increase their dividend every year, and that's what I want you to look for. I want you to look up companies that increase their dividend every year. They're going to pay you out more every year per share. You're also going to see an increase in stock value every year, right? Coca-Cola, for example, it's going to go up by, maybe it's worth $50 right now. Maybe it's worth $52 the next year per share. Maybe it's worth $55 per share the next year. And maybe they also increase their dividends every year and they give you more and more per share. Well, that free money on top may not be much now, but as the value of the stock increases and as the company pays you out more and more and more per share, boom, this difference right here is free money. So if you just held the shares and they didn't pay out a dividends, you're going to see this gain here. This gain right here, the company is literally putting cash in your pocket, basically saying, thank you for holding our shares. Here's some cash. Okay. Dividend stocks are key. Yes, you can make a lot of money getting regular stocks that don't pay dividends, but dividend stocks are going to provide you with a ton of wealth that you wouldn't see otherwise. All right, I think that's about it. Coming up on the end of my conversation here, I got to go get on a meeting. So I think I touched on everything I wanted to touch on. And again, it's just the basics. It's just the basics, guys. This is just fundamental investing, like basically investing for dummies, right? Any other questions that you have, there's a ton of resources on YouTube, on Google. This is a great place to get started. Anything that you didn't understand, go research it a bit more and get some more details. You can also even reach out to me and send me a message and I'll help you out. I'll see what I can do in terms of answering your questions. So